Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a future powered by artificial intelligence. Its demands are insatiable, consuming power grids, generating mountains of heat. It's threatening to crumble under its own weight. Picture these immense data centers humming like giant beasts, housing trillion-dollar AI dreams. In this incredibly high-stakes environment, one company stands out. It acts as an indispensable guardian, really keeping the chaos at bay. We are talking about Vertiv Holdings. They are the very backbone of the cooling and power systems fueling this AI revolution. Today, we confront a crucial question, especially for you as an individual investor. Will Vertiv continue to be the go-to provider for power management, cooling solutions, IT infrastructure for decades to come, especially as AI just keeps pushing the limits of what's possible? This discussion isn't simply an analysis. It's designed to give you the edge you need in a market where AI's vast promise meets some very real-world grit. So let's unpack the absolutely crucial role Vertiv plays. At its heart, this company functions as, well, the indispensable plumber and electrician for the digital age's towering data centers. They are the architects behind the power systems, the cooling units, the IT racks, everything that keeps servers humming, preventing overheating, preventing blackouts. It's truly foundational work.
That's a powerful way to put it, and it's accurate. Think about it like this. Companies like NVIDIA provide the brains, the processing power. Vertiv supplies the life support system for those brains. They prevent the meltdowns in facilities where literally a single hour of downtime can cost millions. Millions of dollars in lost revenue, lost productivity. Their role is entirely about ensuring continuous operation, optimal performance, and critically, the ability to scale. That scalability is absolutely vital with the explosion we're seeing in AI.
So when we talk about these massive artificial intelligence models, things like ChatGPT, which can consume energy equivalent to small cities, Vertiv is the company stepping in to prevent catastrophe. It's about much more than just keeping the lights on. It's safeguarding the actual brain power of our digital world. But when you say catastrophe, can you give us a sense of just how challenging it is to cool these AI supercomputers? What does that really involve?
Oh, it's an immense challenge. Truly. The core difficulty with these high-density AI workloads lies in managing the sheer volume of heat they generate. It's just physics. Traditional air cooling methods, they often fall short. It's like, as I sometimes say, trying to refrigerate a volcano.
A volcano.
Right. These AI clusters generate such intense concentrated heat that conventional methods are simply inadequate. They can't keep up. This is where Vertiv's innovation really comes into play. They've developed advanced hybrid cooling solutions, combining both air and liquid methods in sophisticated ways. This is where they really shine. Their technology is designed to optimize energy use by maybe 20 to 30% compared to older methods. That's critical for efficiency, yes, but also for managing the staggering cost of running these massive operations. Honestly, without these kinds of advancements, the scalability of AI would be severely bottlenecked. Bottlenecked by energy consumption and thermal management challenges. The AI revolution simply couldn't proceed at its current pace without solutions like these.
Okay, so the core business seems clear enough. They sell essential gear and services to data center operators. About 70% of revenue from products, 30% from recurring services. But it's worth noting, for you as an investor, that the technical aspects, things like efficiency metrics, supply chain complexities, they do add layers to grasp. It's not just about selling a box off the shelves, it's about delivering a meticulously engineered solution, one that performs under extreme conditions day in, day out.
Precisely. And understanding concepts like power unit effectiveness, or PUE, really helps you appreciate the engineering challenges involved. Essentially, a lower PUE number means a data center is more efficient in how it uses energy, which translates into massive cost savings over time. Vertiv solutions directly impact these PUE metrics, making them an absolutely crucial partner for any data center operator focused on optimizing costs and, increasingly, their environmental footprint. And that recurring service revenue you mentioned, from things like ongoing maintenance and monitoring, that provides a stable base, a foundation that many purely product-focused companies just don't have. It offers a layer of predictability even in this rapidly evolving market. And that predictability means potentially less volatility for their top line, which is always a good sign for investors looking for stability alongside growth.
Let's shift gears now and turn our attention to the leadership. Who is steering this vital infrastructure company? The team seems to be a blend of industry veterans and innovative strategists, positioned, it seems, quite perfectly to navigate AI's explosive demands. Because it's not just about having good ideas, right? It's having the right people to execute them effectively.
Absolutely. Execution is key. And at the helm, you have CEO Giordano Albertazzi. He brings over 2 decades of experience specifically in critical infrastructure. He's actually risen through the ranks at Vertiv and his predecessors, giving him this deep, ingrained understanding of both engineering and operations. That background has been absolutely crucial in guiding the company toward AI-ready solutions. Look at the strategic acquisition of Coolterra in late 2024. That move significantly bolstered their liquid cooling capabilities. It wasn't just a random purchase. It was a direct, proactive response to the AI boom, a response to the urgent need for efficient thermal management among the hyperscalers, the massive cloud providers like Google, Meta, Microsoft. His leadership ensures the company isn't just reacting to market shifts, but is actively trying to anticipate them, to stay ahead of the curve.
And supporting him, you have Executive Chairman Dave Coate. He's known for his formidable turnaround expertise from his time leading Honeywell. How specifically did his disciplined approach, maybe distinct from prior leadership, really impact Versafe's trajectory after the spinoff, beyond just those impressive financial numbers we see?
Well, Coates' focus on operational efficiency and global expansion is clearly evident. It's almost palpable in the company's recent trajectory. He's a veteran of streamlining complex global organizations. His anecdotes about slashing bureaucracy at Honeywell, for instance, they mirror Vertiv's own streamlining efforts post-spinoff. He famously talked about empowering individual business unit leaders at Honeywell, giving them autonomy to make faster decisions, cutting through layers and layers of approvals. That philosophy seems present at Vertiv. Under his influence, what was a $4 billion revenue base back in 2016 has been transformed into over $8 billion by 2024, doubled. And this growth isn't just organic market lift. It's driven by disciplined cost management and strategic pivots toward high-growth areas like AI. His operational prowess is also reflected in tangible things, like establishing new state-of-the-art facilities in places like India and South Carolina. These are specifically designed to meet that surging AI-driven demand. It's really about instilling a culture of relentless execution, getting things done efficiently and effectively.
And we also see strong contributions from other key officers. They seem instrumental in their specific domains, really rounding out the team.
That's right. It's not a one-man show. You have CFO David Fallon, for instance. He leverages his financial acumen, honed during his time at General Electric. Fallon has been a driving force behind the company's impressive cost controls, which in turn expanded adjusted operating margins to a robust 19% in the second quarter of 2025. That's a significant jump, and it directly impacts the bottom line, profitability. Then there's Anand Sanghi, President of the Americas. He brings extensive sales expertise, crucial for securing those major contracts with the cloud giants, effectively capturing the lion's share of demand in that critical North American region. You also have Stephen Liang, the Executive Vice President and Chief Technology Officer. He's at the forefront, pushing proprietary technology in AI cooling, ensuring their solutions remain cutting-edge and differentiated from competitors. And Carsten Winther, President of Europe, the Middle East, and Africa, EMEA. He has successfully led regional growth amidst Europe's own significant data center surge. Finally, you can't forget the board members like Roger Fredden, people with deep industrial expertise who add vital oversight and strategic guidance. It ensures a well-rounded, experienced leadership team firing on all cylinders. This collective expertise allows them to make incredibly informed decisions, like the partnership with NVIDIA for certified cooling systems. That directly shapes their strategy to really dominate the AI infrastructure space.
It's fascinating how those collective decisions, like the NVIDIA partnership, directly shape their strategy to dominate AI infrastructure. Overall, this leadership team certainly seems exceptional execution, blending that operational grit Dave Coate is known for with some real forward-thinking innovation. But you mentioned earlier, this company isn't founder-led in the traditional sense. It evolved through corporate ownership changes over the years. How does that structure align incentives with individual investors like you listening, especially compared to, say, a startup where the founder still holds significant equity?
That's a great question, and it's actually a testament to how a well-structured public company can operate effectively. While it's true, Vertiv isn't founder-led, it evolved from Liebert Corporation, then through Emerson Electric, and finally the spin-off this structure, arguably, aligns incentives exceptionally well with your interests as an individual investor. How? Well, executive compensation is heavily tied to stock performance and to long-term metrics like adjusted earnings before interest, taxes, depreciation, and amortization growth, or EBIT growth. That EBITDA growth was up a remarkable 42% in the second quarter of 2025. That directly benefits executives and shareholders simultaneously. Furthermore, you see things like stock repurchase programs. The current $3 billion authorization runs through 2027. That further signals alignment by boosting shareholder value, especially amidst these powerful AI tailwinds. The lack of founder involvement certainly hasn't hindered their outperformance. Shares have soared over 940% in 5 years. That significantly outpaces broader tech benchmarks. It demonstrates that world-class operators, focused on execution and aligned incentives, can deliver exceptional results even without that traditional founding visionary at the helm.
That is a powerful testament to their operational prowess, absolutely. What about the company's core mission and vision? What guides these leaders day to day?
Their mission is crystal clear, really. It's to deliver critical digital infrastructure that ensures their customers' vital applications run continuously, perform optimally, and can scale effectively with business needs. Essentially, they aim to be the reliable backbone for our hyper-connected world, and that emphatically includes AI's voracious demands for power and cooling. The vision extends beyond just reliability. It's about pioneering sustainable AI-ready solutions, things like modular data centers, advanced liquid cooling. They have a clear goal: capture a larger slice of that estimated $100 billion AI data center total addressable market by 2025. That's a huge target. And this includes innovation specifically designed to reduce energy consumption by up to 30% in high-density setups, demonstrating a commitment not just to performance, but also to environmental responsibility, which is increasingly important for their hyperscale clients and for everyone, really.
And how does that translate into their culture on a day-to-day basis? It's one thing to state a mission on a website, quite another to actually live it across a global organization.
Right. They foster what they call a high-performance ethos, sometimes framed as one Vertiv, one world. It emphasizes accountability, continuous innovation, and sustainability. And this isn't just corporate rhetoric. It's reinforced through tangible initiatives. Look at their 2023 Responsible Business Report. It details how employees worldwide collaborate on environmental, social, and governance goals, ESG goals. For example, they're actively focused on utilizing low global warming potential refrigerants in their cooling technology. That directly contributes to their sustainability mission. Anecdotes from Dave Coates' tenure also highlight this cultural resilience. During those severe supply chain crunches in 2022 caused by the pandemic, teams apparently pivoted incredibly rapidly, dual sourcing critical components, finding alternative solutions. That embodies a resilient culture, one that effectively turns challenges into opportunities for growth and learning. This explicit alignment where their mission and vision are tied directly to key objectives, to executive incentives, it propels their vision forward. It positions the company not just as a vendor selling equipment, but as a true, indispensable partner in AI's long-term infrastructure story.
Every strong company seems to have a compelling origin story. Vertiv is no exception, though its journey seems marked by continuous reinvention, adapting to these massive shifts in technology over decades.
Absolutely. It's a story of evolution. It began way back in 1965 as Liebherr Corporation. They were true pioneers, specializing in precision air conditioning, specifically for mainframe computers back then. That was a pivotal moment, positioning them extremely early in the nascent field of IT cooling. The company grew significantly after being acquired by Emerson Electric in 1981. It became a substantial $4 billion powerhouse within Emerson by 2016. That shows consistent growth and increasing relevance in digital infrastructure over a long period.
And then came that pivotal spinoff and public debut, marking a new chapter, a new identity for the company. That must have come with its own set of unique challenges, especially emerging from a larger, diversified corporate structure like Emerson.
You're absolutely right. Transitioning is never simple. Platinum Equity, the private equity firm, strategically spun it off as Vertiv in 2016. They were placing a significant bet on the burgeoning data center boom, which was just beginning to really accelerate at that time. Then the 2020 merger with a special purpose acquisition company, or SPAC, called GSAH, marked its public rebirth. That deal raised $1.2 billion, providing crucial capital to fuel further expansion and capitalize on market opportunities. But, as you hinted, it wasn't without its drama or challenges. Early post-merger, they faced severe supply chain woes stemming from the COVID-19 pandemic. That really tested their resilience as a newly independent public company. This period led to a crucial pivot in 2022. They leaned heavily into modular solutions, prefabricated data center components. It was a strategic move that proved highly successful, boosting orders by 30% by 2024 and demonstrating their adaptability under pressure. It really showed their ability not just to survive difficult times, but to actually thrive and reposition themselves strategically.
What have been some of the most significant milestones along this path of continuous adaptation and reinvention?
Well, a few stand out. The 2021 acquisition of E&I Engineering for $1.8 billion was a big one. That significantly enhanced their capabilities in power distribution, specifically switchgear. That acquisition enabled them to capture an impressive 80% of their revenue directly from data centers, really solidifying their focus on that core market. Another critical milestone, as we touched on, was the 2024 Coolterra acquisition. That move accelerated their liquid cooling capabilities, providing precisely what was needed for the high-density demands of modern artificial intelligence workloads. And this happened amidst a significant market shift, where the hyperscalers Meta, Google, Amazon, Microsoft are rapidly increasing their capital expenditure on data centers, making advanced liquid cooling an absolute necessity, not just a nice-to-have. These acquisitions weren't just about getting bigger, they were strategically targeted moves to position the company perfectly for the future of AI infrastructure.
Their track record really does shine in their ability to adapt, adapting to changing technological landscapes, shifting market demands, competitive pressures.
Absolutely. From those industrial roots within Emerson Electric to now dominating AI infrastructure, it's quite a transformation. Their revenues surged an impressive 17% to hit $8 billion in 2024. Organic growth, stripping out acquisitions, was still a very strong 16%. That consistently outpaces competitors like Schneider Electric. Their market share in thermal management climbed to around 25% globally, and this momentum continued, illustrated by a strong 24% sales jump in the first quarter of 2025, hitting $2 billion. That growth was directly driven by those powerful AI tailwinds we keep mentioning. It demonstrates their ability not just to grow, but to grow strategically and profitably, capturing share in a highly competitive, high-stakes market.
It definitely sounds like a company that learns from its challenges and emerges stronger, but what kinds of challenges did they face specifically, and how did those experiences forge this resilience we're talking about?
Indeed. They've certainly faced headwinds. While the recent performance is stellar, investors shouldn't forget the early public market volatility. The stock dipped significantly, maybe 65% back in 2022. That was a period of real concern. But the subsequent rebound, soaring over 80%, underscore their remarkable capacity for reinvention and resilience. This wasn't just market luck, it was the direct result of strategic actions. Their rapid pivot to modular solutions, aggressively optimizing supply chains, and focusing intensely on the emerging, high-margin AI opportunity. This positions them today as an indispensable player in an AI-driven world. A world where even minor cooling failures could halt trillion-dollar computations and bring entire AI operations, entire businesses potentially, to a standstill. Their journey is really a testament to adapting, enduring, and ultimately thriving in a dynamic, often unforgiving technological environment.
Okay, let's dive a bit deeper now into how this company actually operates day to day. Their business model, you said, is straightforward. They provide the foundational infrastructure for the digital age, the lifeblood for data centers.
That's right. Fundamentally, they design, they manufacture, and they service the essential components. Power systems, cooling units, IT racks the physical infrastructure that keeps servers running optimally. You can think of it as the critical life support system for the massive power demands generated by AI and other intensive computing tasks. Their primary role is preventing those catastrophic meltdowns in facilities where, as we've said, even a minute of downtime could cost companies millions in lost revenue and productivity. It's all about enabling continuous operation at immense scale.
But you also mentioned nuances, especially with AI's intense demands for both power and thermal management. It's clearly not just about standard off-the-shelf equipment anymore. It demands highly specialized, highly efficient solutions.
Exactly. It's becoming much more sophisticated. For these high-density AI workloads, you encounter complex technical aspects like hybrid cooling systems, which intelligently combine both air and liquid cooling methods. Efficiency metrics, like that power usage effectiveness, or PUE, become absolutely crucial here. It's not just a benchmark, it's a key performance indicator. Cooling a modern AI supercomputer, as we discussed, is genuinely like trying to refrigerate a volcano because of the sheer concentrated heat generated by those advanced chips. Vertiv's technology is specifically designed to optimize energy use, aiming for that 20 to 30% improvement range. That translates directly into significant cost savings and, importantly, environmental benefits for their clients. Now, while the core business model selling hardware and services is relatively accessible for investors familiar with industrial or infrastructure companies, there are complexities. Things like managing intricate global supply chain logistics, navigating a patchwork of varying regulatory compliance standards across different countries, especially around energy efficiency regulations, these might challenge newcomers to the space. But fundamentally, yes, it's about selling essential gear to data center operators, about 70% of revenue, and providing ongoing services, the other 30%.
What makes their approach unique in this competitive landscape? There are other large, capable companies operating in this space. What truly sets Vertiv apart from the pack?
What really sets them apart is their incredibly focused approach. It's sometimes described using Jim Collins's hedgehog concept. They excel at one big thing, the critical intersection where power, cooling, and IT infrastructure converge within the data center. They seem driven by a deep passion for maximizing uptime and reliability for their customers. And they're fueled by an economic engine that directly benefits from AI's exponential needs for their specific solutions. Unlike more diversified industrial conglomerates, Vertiv is essentially a pure-play entity in this space now, deriving that impressive 80% of its revenues specifically from data centers. This intense specialization allows for highly targeted innovations, things like the Vertiv one-core prefabricated modules. These can dramatically slash deployment time by up to 50% for new AI setups. That's a massive advantage for hyperscalers who are racing to bring new capacity online as fast as possible. Their model also cleverly integrates hardware with sophisticated software analytics and ongoing services. This creates incredibly sticky ecosystems. Once a customer is using their integrated system, it's harder to switch out. For instance, look at their partnership with Scala data centers in Latin America. They deployed Vertiv thermal management solutions, and it resulted in a reported 15% cut in energy costs for Scala. That's real value. This pure-play focus aligns their passion with developing best-in-class technology, like their advanced liquid cooling, offering potentially 10 times better thermal efficiency compared to traditional air cooling, positioning them as an indispensable AI infrastructure linchpin.
How do they manage to distribute these solutions globally, reaching such a diverse range of customers, from those massive hyperscalers needing custom solutions down to the smaller enterprises needing more standard products?
They employ a smart, hybrid distribution strategy. It allows for both broad reach and tailored solutions depending on the customer segment. This includes direct sales teams engaging with the hyperscalers, the Googles, the Metas. For those large-scale, often highly customized projects where specific needs and massive volumes require direct, high-touch engagement. They also form strategic partnerships with a network of value-added resellers and distributors. This helps them reach the mid-market effectively, extending their presence to a wider array of businesses that might not need fully bespoke solutions but still require reliable infrastructure. And for more standardized products, they utilize efficient online portals, making it easy for customers to order common components. They've also been quite innovative with their configure-to-order approach, leveraging digital tools that can speed up the quote generation process by as much as 40%. That improves customer experience and internal efficiency. This whole strategy supports scalability. By effectively leveraging a global network of over 1,000 channel partners, they can enable rapid deployment of their solutions, even into niche markets or geographically diverse locations. And this model has proven exceptionally effective. Just look at the 26% sales growth they reported in the fourth quarter of 2024. With their recurring services component, notably enhancing long-term customer loyalty and stickiness.
Okay, and what about the predictability of their revenue? In a market moving as fast as AI infrastructure, how much can we as investors rely on consistent earnings streams from Vertiv?
Well, their revenue profile blends a good degree of predictability with some inherent variability. That's pretty typical for companies with both significant product sales and a substantial service component. About 30% of their revenue is recurring. This comes from those services we mentioned, maintenance contracts, remote monitoring, things like that. Critically, these services are often backed by multi-year contracts with remarkably high renewal rates, reportedly around 95%. That provides a significant layer of stability and predictability, even amidst potential AI market volatility. The remaining 70% comes from product sales. These are inherently more cyclical, tied to customer capital expenditure cycles. However, even this segment is substantially bolstered right now by a massive $6 billion backlog, as reported in the second quarter of 2025. This backlog, which is up an impressive 50% year over year, represents locked-in orders, particularly large commitments from hyperscalers building out their AI capacity. This healthy mix of recurring revenue and a strong backlog significantly enhances their overall financial stability. We saw that reflected in their robust 35% overall revenue growth in the second quarter, reaching $2.64 billion. The predictability of their revenue base actually strengthens further as contracts with AI clients tend to be longer-term commitments. This helps mitigate potential downturns in shorter cycle product sales. That backlog figure is a crucial indicator for you as an investor. It provides strong visibility into future revenue streams.
Let's transition now to the heart of what Vertiv actually offers, its product portfolio and the operational prowess that brings it all to life. This is where their engineering depth and manufacturing expertise really come to the forefront.
Right. Their portfolio centers on three core pillars, essentially. First, power management. This includes sophisticated, uninterruptible power supplies UPS systems, which are advanced battery backups and electrical switchgear for power distribution. Second, thermal management. This encompasses a wide and increasingly sophisticated range of cooling systems, from traditional air conditioning to advanced liquid cooling. And third, IT infrastructure. This covers the physical support structures like server racks, cabinets, and integrated monitoring solutions that provide visibility into the data center environment. All these product lines achieve a very strong product market fit, specifically in the data center space. Remember, 80% of their revenue comes directly from providing these essential solutions, particularly vital amidst AI's increasingly heat-intensive demands. They are not trying to be everything to everyone. They are deeply focused on what is absolutely critical to the functionality, reliability, and efficiency of modern data centers.
What about recent advancements and their innovation pipeline? Are they truly keeping pace with the breakneck speed of change in AI infrastructure requirements, or are they potentially playing catch-up in some areas?
No, they are definitely not playing catch-up. They are actively driving innovation in key areas. Recent launches really highlight this. Take the Vertiv one-core prefabricated modules launched in 2025. These are designed to dramatically accelerate AI deployments by simplifying the construction of, say, a standard 5-megawatt data center building block. This has a direct positive impact on hyperscalers, enabling rollouts that are potentially 30% faster. And it contributed significantly to that impressive 35% sales growth they saw in the second quarter. Their product roadmap clearly emphasizes AI-specific innovation. Notably, expanding their liquid cooling capabilities, significantly boosted by the Coolterra acquisition, to achieve that remarkable potential for 10 times better thermal efficiency in high-density compute environments. And they're backing the strategy with substantial investment. Their research and development spending is up 20%, projected to hit $300 million in 2025. A lot of that is focused on developing next-generation hybrid cooling systems that integrate seamlessly with technology from partners like NVIDIA. Looking even further ahead, their services roadmap includes things like a predictive analytics platform, possibly called an AI hub, offering real-time optimization capabilities that could potentially cut data center downtime by an incredible 50% for their clients. That's huge value.
Where are all these innovations actually brought to life? What does their global operational footprint look like, and how does it strategically support their goals of serving this global market?
Their operational footprint is truly global, strategically positioned to meet demand efficiently across key regions. The headquarters remain in Columbus, Ohio. That serves as the nerve center for overarching strategy, R&D leadership, and corporate functions. Key manufacturing facilities are spread out. They have a major site in Pelzer, South Carolina, focusing heavily on thermal management products and modular solutions for the Americas market. Pune, India, is another crucial hub, which saw significant expansion in 2024 specifically to support growth in the Asia-Pacific region. Monterrey, Mexico, is a significant center for power systems assembly, leveraging nearshoring advantages. They also maintain important sites in China, primarily for component manufacturing and sourcing, and in Europe, specifically Ireland, which became a key center for ENI switchgear production following that acquisition. Now, while they own critical plants like the Pelzer facility, they strategically lease others, such as distribution centers in the EMEA region, for greater flexibility and scalability. They also selectively outsource some non-core manufacturing, like electronics assembly, primarily to partners in Asia to optimize costs. But critically, core technology, things like their proprietary cooling coils and advanced control systems, remains firmly in-house. This ensures stringent quality control and protects their valuable intellectual property.
This naturally leads us to discussing their competitive advantages.
Wow.
What truly sets Vertiv apart and creates a sustainable moat, as investors like to say, in the market, something that competitors would find difficult or costly to replicate.
Well, Vertiv operates within what economists would describe as an oligopolistic market for core data center infrastructure. Basically, a few dominant global players hold significant market share. The structure itself creates high barriers to entry. Things like the immense scale required, the deep technical expertise needed, the established customer relationships, these are hard for newcomers to overcome. With approximately 25% market share in thermal management, Vertiv significantly benefits from this market structure. The high capital requirements necessary just to enter this space effectively deter many potential new competitors. This helps sustain their healthy gross margins, which were around 36.6% in 2024. However, the rapid rise of AI introduces a slightly different dynamic, almost a form of monopolistic competition within specific niches, particularly in areas like advanced liquid cooling, where Vertiv hold a clear leadership position. They're capturing maybe 30% growth in those hyperscale segments related to AI cooling. This leadership in high-growth niches helps shield their earnings from broader market pressures, as evidenced by that strong 26% overall sales increase they posted in the fourth quarter.
And how do economies of scale play into this advantage, especially with the recent manufacturing expansions? Does being bigger truly mean being better or more efficient in this business?
Oh, massively. Scale is a huge advantage here. Their larger operations, particularly after those significant capacity expansions in 2024, have directly led to tangible benefits. For instance, a reported reduction in cost per unit of around 20% for some of their core cooling products. That allows them to consistently outpeak smaller rivals on cost efficiency. With $8 billion in annual revenue, their sheer size enables bulk procurement of raw materials and components at favorable prices. It allows for highly efficient global manufacturing processes across their network of factories. This yields significant cost efficiencies. For example, it contributed to a 57% jump in adjusted operating profit back in the fourth quarter. And this advantage is amplified in the AI sector. The high-volume orders coming from major players like Meta or Google drive higher margins for Vertiv due to these scale efficiencies. It makes it incredibly difficult for smaller, less established players to compete effectively on either price or production volume.
Do they benefit from network effects at all, where the value of their product or service increases as more customers use it? That seems less obvious in a physical infrastructure business compared to, say, software.
It's more subtle than in software, certainly, but their offerings do exhibit mild network effects. As more data centers adopt their integrated systems, think about their power, cooling, and monitoring solutions working together, perhaps managed by their Vertiv AI Hub software, the overall value for all users rises. How? Through improved ecosystem compatibility. Standards emerge, integration becomes easier. Furthermore, their software analytics platforms continuously improve as they gather more anonymized operational data from a larger user base. This leads to enhanced performance insights, better predictive maintenance algorithms, and that fosters greater customer loyalty. For example, they've reported that adoption by over 12,000 users in their modular solution segment grew 30% year over year. As shared insights across this larger user base genuinely enhance performance and reliability for everyone involved. So, while it's not the potent exponential network effect you see in social media or online marketplaces, it is definitely a contributing factor to customer stickiness and makes their integrated ecosystem more valuable over time.
What about their strategic positioning against specific competitors? How do they differentiate themselves beyond just scale and focus? What makes their solutions uniquely valuable in this intense AI race?
They uniquely position themselves as AI specialized, really leaning into providing those advanced liquid cooling solutions that many competitors, particularly the more diversified ones, often cannot replicate quickly or perhaps at the same scale or efficiency level. Their strategic approach also includes forging deep, integrated partnerships with key players in the AI ecosystem. The collaboration with NVIDIA to develop certified infrastructure solutions is a prime example. This focus and these partnerships have elicited a remarkably positive market response, directly reflected in things like their substantial 77% earnings per share growth back in the fourth quarter of 2024. They are not just selling commodity products, they are positioning themselves as enabling a critical piece of the entire AI ecosystem, making them a preferred, almost essential partner for companies building out AI capabilities.
Once a customer integrates Vertiv systems, their power, their cooling, maybe their management software, are they truly locked in? How difficult or prohibitively costly is it for a large data center client to realistically switch to another provider down the line?
High switching costs certainly create a significant lock-in effect for customers, especially the larger ones. Think about it. Integrated power and cooling setups in a large data center represent millions, sometimes tens of millions, of dollars in capital investment. Reconfiguring that complex infrastructure to accommodate a different vendor's equipment would involve enormous expense. Not just the cost of new equipment, but also the cost and risk of significant downtime during the transition period. Downtime, as we've established, is the enemy. So switching is both a substantial financial burden and a huge logical impediment for customers. It's a testament to the trust placed in Vertiv's uptime guarantees, which you see reflected in the long-term contracts they secure with hyperscalers. These often span many years and involve massive ongoing investments. It's almost an emotional decision, too, in a business sense. Customers rely on Vertiv for their mission-critical operations. Changing providers introduces massive, often unacceptable risks to their business continuity.
How strong is their brand? In an industry that might seem purely technical, focused on specs and performance, does brand reputation actually matter? Does it command loyalty or pricing power?
You might be surprised, but their brand is highly trusted, especially for reliability. And that trust absolutely enables them to command premium pricing in the market. It's built on a long legacy, dating all the way back to the original Liebert brand established in 1965. They effectively leverage this long-standing reputation for engineering excellence and dependability. Reports suggest they command maybe 10–15% premiums on some of their core products compared to less established competitors. They exercise significant pricing power derived from their consistent quality and proven performance, especially in these demanding AI deployments where failure is not an option. This fosters a strong, almost implicit connection with customers through their brand promise of zero downtime guarantees for critical operations. Reliability is their brand.
Do they possess any cornered resources? Unique assets or capabilities that give them an enduring edge that competitors simply can't easily replicate or acquire?
Yes, they absolutely do, across several categories. First, intellectual property. They hold over 2,000 patents, specifically in critical cooling technology. That provides a strong legal barrier against direct copying. Second, hard assets. Those strategically located and recently expanded factories we discussed. Those are difficult and extremely costly for new entrants to build from scratch to achieve similar scale and efficiency. Third, strategic partnerships. Collaborations like the one announced with Oklo, exploring advanced, potentially nuclear power solutions for data centers, are not readily available to all competitors and signal forward thinking. And fourth, perhaps one of the most significant yet often unappreciated advantages, their exceptional ability to attract and retain top engineering talent. They consistently draw leading experts in thermal management, power systems, and increasingly AI-related infrastructure challenges, often using attractive stock incentives in an industry currently facing significant talent shortages. This talent advantage is a powerful, less tangible moat for you to consider.
And what about their internal processes? Are there unique operational efficiencies, proprietary methods, or specialized know-how developed over decades that set them apart from newer players?
Yes, definitely. Their unique internal processes, refined over decades of operation in this specific field, yield significant cost advantages and performance benefits that are genuinely difficult for competitors, especially newer ones, to replicate quickly. For instance, their proprietary predictive maintenance algorithms, developed using vast amounts of operational data from their installed base, reportedly cut service costs for customers, and for Vertiv, by an impressive 25%. That ensures greater efficiency and reliability for clients, while boosting Vertiv's own service margins. Furthermore, their proprietary liquid cooling technology, constantly being refined and aiming for that potential 10 times better thermal efficiency versus traditional air cooling, clearly outperforms many existing solutions on the market. These internal efficiencies and technological advantages are a true competitive edge because they are deeply embedded in their operations, their culture, and their intellectual property portfolio. They are hard to copy effectively.
It certainly seems their timing couldn't have been better, especially with the sudden, explosive growth in AI demand. Was this purely a stroke of incredible luck? Or was there some element of strategic foresight involved in being ready?
It feels like a combination of both, doesn't it? Some fortunate timing mixed with astute strategic positioning. The AI demand surge really hit critical mass, just as Vertiv was significantly ramping up its cooling capabilities, particularly in liquid cooling, following their 2020 public listing and the subsequent acquisitions. This granted them a crucial first-mover advantage in providing high-density cooling solutions at scale. It allowed them to capitalize on the initial wave of AI build-outs and perhaps avoid some early pitfalls, like overinvestment, before the demand truly materialized. Their agility since then has been impressive, seeing orders consistently top $3 billion per quarter in 2025, seeing rapid product launches like their one-core modules designed to optimize customer supply chains and speed deployment. This swift execution, this ability to deliver at scale, definitely discourages competitors. Their efficiency drives and speed to market far surpass the slower pivots we've seen from some other, perhaps more diversified, players in the market.
So, pulling it all together on the competitive front, beyond all these specific advantages we've discussed, are there any overarching factors that really consolidate their strong position in the market?
Yes, I think two stand out. First, as we've emphasized, their pure play focus on data centers. With 80% of their revenue derived from this single market, it fundamentally distinguishes them from more diversified industrial peers who have many other business lines and priorities to juggle. This intense specialization means they live and breathe data center infrastructure challenges every single day, and it shows in their tailored solutions and deep customer understanding. Second, they have cultivated a strong sustainability edge. Their focus on developing energy-efficient, low-emission cooling technologies aligns perfectly with AI's growing demand for environmentally responsible, green infrastructure. This isn't just good PR. It's becoming an increasingly important decision factor for major tech companies under pressure to reduce their carbon footprint. It sets Vertiv apart as a forward-thinking partner committed to sustainable growth.
Okay, with such a strong foundation and clear competitive advantages, let's explore their growth strategy and future potential more deeply. How are they planning to capitalize on these powerful trends and continue their impressive upward trajectory?
Their growth strategy is quite explicit and multifaceted. It's not just one thing. It's several levers working together, all directly driven by AI's seemingly insatiable infrastructure needs. First, market penetration. This involves upselling existing products, like their advanced uninterruptible power supplies, or newer cooling solutions, to their current base of clients. This deepening of relationships with hyperscalers led to that impressive 23% organic order growth we saw in the first quarter of 2025. Second, market development. This targets new geographies where data center growth is accelerating. For example, expanding aggressively into Latin America through strategic partnerships, effectively exporting their AI-ready cooling solutions to capture new demand. Third, product development. This focuses on continuous enhancements to existing lines, like the Vertiv One-Core modules for more scalable AI deployments, and developing entirely new product categories, like the next-generation liquid cooling line stemming from the CoolTera acquisition. Other strategies include opportunistic mergers and acquisitions to acquire new technologies or market access, and strategically doubling manufacturing capacity in key regions like North America and India to ensure they can meet anticipated future demand without constraints.
What kind of growth potential does this aggressive, multi-pronged strategy truly unlock for the company, and how does that translate into potential future revenue streams that we as investors can anticipate?
The opportunities appear abundant, frankly. Entering high-growth Asia-Pacific AI markets more deeply, for instance, could realistically add an estimated $2 billion in annual revenue by perhaps 2027, based on market projections. New products like their advanced hybrid cooling solutions target a massive global market segment, potentially worth $50 billion over the next several years. Their past successes, such as achieving a 30% order surge directly attributable to AI demand, indicate a strong potential for continued expansion and market share gains. However, it's always prudent for investors to consider potential risks. Saturation risks could eventually emerge in more mature market segments if the AI boom were to significantly slow down or shift geographically faster than anticipated. Fundamentally, though, their products apply broadly across cloud computing, telecommunications, and even industrial sectors. But their sharp focus on AI niches emphasizes scalability, implying massive potential reach. Current AI data centers could also expand significantly into distributed edge computing environments in the future, opening up yet another avenue for growth. This adaptability, this ability to serve multiple adjacent markets, even with the strong AI focus, means they're not putting all their eggs in just one basket.
What are the main underlying drivers propelling this impressive growth trajectory forward right now? What forces are creating these tailwinds?
The key drivers are quite clear and interconnected. First and foremost, the ongoing massive build-out of AI-specific data centers. This ties directly to that 80% of their revenue coming from the data center market. That's the biggest engine. Second, related to that, is the surging capital expenditure from the hyperscalers, Google, Meta, Microsoft, Amazon. They are investing billions upon billions in AI infrastructure, and a significant chunk of that flows to companies like Vertiv. Third is the rapidly increasing demand specifically for liquid cooling solutions, offering that potential 10 times greater thermal efficiency compared to traditional air cooling makes it almost mandatory for dense AI racks. This is a major technological shift Vertiv is leading. Fourth is their aggressive global expansion, building out capacity and sales presence in key growth regions. Fifth is the stability provided by that substantial high-margin 30% recurring service revenue base. Sixth are the synergies they're realizing from strategic mergers and acquisitions, like integrating CoolTera's expertise and E&I's power distribution capabilities. And finally, increasingly stringent sustainability regulations worldwide actually favor their more efficient, low-emission technologies, creating a compliance-driven demand tailwind as well.
Let's pivot now to the challenges and risks. No company, no matter how well positioned, is without potential vulnerabilities. What are the major risks this company faces, and how resilient is it really in the face of these potential headwinds?
Well, starting with the supply chain. It's remarkably diverse now, spanning over 50 key suppliers across multiple continents. This significantly reduces their reliance on any single region or supplier, which was a lesson learned the hard way during the pandemic. For example, their proactive dual sourcing of critical semiconductor chips effectively mitigated the widespread shortages experienced back in 2022, and their ongoing supply chain resiliency programs enabled them to achieve that impressive 35% growth even in the second quarter of 2025, amidst ongoing global logistics complexities. However, vulnerabilities can always persist, particularly for highly specialized electronic components primarily sourced from Asia. Though they actively mitigate this risk through strategies like building strategic inventory buffers and increasing local manufacturing capabilities in places like Mexico and the US, it's an ongoing effort, a constant balancing act, but they've shown they can navigate it effectively so far.
What about customer concentration risk? Given the massive scale of hyperscalers, do they rely too heavily on just a few very large clients, which could become a vulnerability if one of them pulls back spending?
That's a valid concern, but they actually have a surprisingly broad and well-diversified customer base, despite the headlines about hyperscaler deals. Geographically, their revenue is nicely spread. Roughly 56% comes from the Americas, but then you have 22% each from Asia-Pacific and the EMEA region, Europe, Middle East, Africa. This spreads their market risk globally. Furthermore, their customers span diverse industries beyond just cloud computing, including major telecommunications providers and large industrial companies with significant computing needs. Company disclosures explicitly state that no single client accounts for more than 10% of their total revenue. This provides a significant layer of stability, even with their strong strategic focus on winning large AI-driven deals from the hyperscalers. This broad distribution really safeguards them from the potential impact of any single customer, significantly altering their capital expenditure plans unexpectedly.
Could their impressive competitive advantages erode over time? Is their moat truly sustainable in the long run, especially in such a fast-evolving technological landscape? Could a new breakthrough cooling technology emerge from a competitor and disrupt their position?
It's a fair question. Their competitive moat appears sustainable for the medium to long term, primarily due to their extensive patent portfolio, over 2,000 patents, remember, and their significant economies of scale, which are very hard to replicate. However, some erosion is always possible. New entrants might chip away at market share in less specialized segments of the broader data center market. Or, more disruptively, a radical technological shift could occur. For instance, if entirely new immersion cooling technologies developed by a competitor prove dramatically superior and cheaper, that could pose a significant challenge. The rapid pace of AI development absolutely demands constant innovation from Vertiv just to stay ahead. They need to ensure their proprietary technology remains superior and relevant. They simply cannot afford to stand still, and their R&D investments show they understand that imperative.
How anti-fragile is the company? Nassim Taleb's concept, does Vertiv merely withstand chaos and unexpected disruptions, or can it actually thrive and emerge stronger from them?
Based on recent history, Vertiv appears to actually thrive in chaos, exhibiting strong anti-fragile characteristics. The severe COVID-19 disruptions, for instance, didn't cripple them. Instead, that period spurred significant innovation in modular, prefabricated solutions within the company. This ultimately strengthened their product offerings and positioned them better for the subsequent AI boom, which demanded rapid deployment. Their adept navigation of the 2024 tariff issues by strategically boosting domestic production in North America to mitigate impacts is another prime example. They didn't just absorb the hit, they adapted their footprint. This kind of adaptability and ability to pivot constructively under pressure is akin to muscles toughening under stress. It seems to make the company more robust and resilient for whatever future shocks may come.
And what about their fundamental longevity in the market? Looking out decades, will their core products and services remain essential, or could AI evolve in ways that bypass their current infrastructure solutions?
Looking at the long-term secular trends, things strongly favor Vertiv's continued relevance. The widespread accelerating adoption of AI, projected at that 30% compound annual growth rate, CAGR, for data center capacity is a massive, enduring tailwind. Broader demographic shifts towards digitalization, the growth of cloud computing, 5G deployment, the Internet of Things, all these require more data center capacity. Plus, the global energy transition puts a premium on efficiency, playing directly to Vertiv's strengths. They are exceptionally well positioned, particularly through their focus on energy-efficient and sustainable cooling technologies, to capitalize on these intersecting megatrends. This indicates a high probability, maybe an 80% likelihood or more, that their core products and services will remain essential infrastructure far into the future. AI's ever-increasing energy demands practically guarantee their relevance. And don't forget that stable 30% recurring revenue stream, coupled with a substantial $1.2 billion cash buffer on their balance sheet. That provides significant financial resilience to weather any potential economic downturns along the way. They seem built for the long haul.
Okay, so acknowledging the strengths, what are the main specific risks to their impressive growth trajectory that you as an investor should keep front of mind, perhaps beyond the broader ones we've already covered?
All right, getting specific. Key risks to monitor would include potential market saturation in certainly mature non-AI data center segments, which could slow overall growth. Increasing competitive pressures, not just from established players like Schneider, but also potentially from emerging, agile innovators focusing on niche cooling technologies. And of course, the risk of a potential deflation of the current AI hype cycle if enterprise adoption slows or underperforms the very high expectations currently priced in. In terms of no unknowns, things we know could happen but can't predict precisely, we must consider further supply chain disruptions, perhaps geopolitical in nature, which could impact production schedules, and the potential for further tariff hikes or trade disputes, which could potentially increase their input costs by maybe 5 to 10%, depending on the specifics. As for unknown unknowns, the black swans, these are by definition harder to predict. But you can imagine scenarios like widespread geopolitical bans on AI development or deployment in certain key regions. Or, perhaps less likely but still possible, a truly disruptive breakthrough cooling technology emerging from a university lab or startup that completely obsoletes Vertiv's current portfolio. Though that seems a low probability event given their own significant R&D efforts and market position.
Let's turn our attention now squarely to the financial picture. The numbers here truly seem to scream AI-fueled acceleration. They tell a compelling story for us as investors trying to understand the underlying health and momentum of the business.
They absolutely do. As of the second quarter of 2025, their financials paint a picture of a company that isn't just riding the massive AI wave, but is actively shaping it and profiting handsomely from it. You could almost say they're effectively turning unavoidable data center heat into tangible investor value. Revenue growth hit that impressive 35% year-over-year mark, reaching $2.64 billion just in the second quarter. Their updated full-year guidance now stands at $10 billion, which represents a substantial 24% increase over the previous year. This exceptional growth is largely, almost directly, driven by AI-related orders, which are consistently exceeding $3 billion per quarter. This isn't just steady growth, it's a surge, a real acceleration driven by fundamental demand.
And what about profitability? It's one thing to grow revenue rapidly, but are they efficiently converting that robust top-line growth into strong earnings and cash flow for us as shareholders?
Yes, their profitability metrics have expanded impressively alongside the revenue growth. Adjusted operating margin reached 19% in the latest quarter, up significantly from 16.5% previously. This reflects a combination of astute procurement wins, managing input costs effectively, and strategic price hikes that have successfully outpaced inflationary pressures. They're effectively turning every AI server rack they equip into higher incremental profits. Their Rule of 40 score a quick metric often used for high-growth software companies, software as a service or SaaS, to gauge health by combining revenue growth rate and profit margin, stands at an outstanding 59%, 35% growth plus 24% FCF margin approximation, or using 19% up margin puts it at 54%. For a business heavily involved in hardware like Vertiv, to hit numbers like that indicates exceptional operational efficiency and incredibly strong demand for their core products. It signals they're performing with the financial characteristics often associated with high-growth tech platforms. Return on invested capital, or ROIC, a key measure showing how efficiently they use the capital entrusted to them to generate profits, is also strong, running around 25%. That showcases their highly efficient use of capital. For example, maybe $250 million in capital expenditure invested in 2025 is yielding potential 30% returns via increased output from new, efficient manufacturing plants. Their balance sheet looks solid, too. Cash position is robust at $1.2 billion. Their current ratio, current assets divided by current liabilities, is healthy at 1.5 times. Debt to equity is manageable at 1.2 times, notably down from previous levels due to strategic debt refinancings, providing ample liquidity for ongoing AI investments and pivots. Book value per share continues to grow, up maybe 15% year over year to around $10 per share, underscoring significant asset buildup on the balance sheet. And critically, free cash flow, the cash left over after running the business and investing in its future, surged 50% to about $800 million over the trailing 12 months. That comfortably funds substantial stock repurchase programs, which totaled maybe $600 million recently, returning capital to shareholders. From an industry-specific perspective, that backlog, standing at $6 billion, up 50% year over year, is huge. It signals a book-to-bill ratio comfortably above 1, around 1.3 times recently, which is significantly stronger than many peers and indicates very strong future revenue visibility.
How does this stellar financial performance stack up directly against their main competitors in the broader data center infrastructure market? Are they truly leading the pack by these metrics?
Yes, they consistently outperform key competitors on several fronts. The recent 35% revenue growth significantly trumps figures from players like Schneider Electric, who might be seeing growth closer to 15%, or Eaton, often around 10% in comparable segments. Moreover, Vertiv's operating margins are consistently running maybe 200 basis points, or 2 full percentage points, higher than many of their direct competitors in this space. The return on invested capital, ROIC, also typically beats the industry average, which might hover closer to 18%, clearly highlighting their competitive edge and superior capital efficiency, likely driven by that AI focus. Now, it's true their valuation multiples are often higher. Their trailing price-to-earnings, PE ratio, might be around 50 times, compared to some peers trading closer to 30 times. However, this premium is frequently seen by the market as justified due to their significantly higher growth trajectory. Importantly, the forward price-to-earnings ratio, based on analyst projections for next year's earnings, drops to a more reasonable 35 times. This indicates that as their earnings continue to grow rapidly, the valuation becomes more attractive relative to future potential.
What about the longer-term financial trends? Are these recent, incredibly strong results just a temporary blip fueled by the initial AI frenzy, or do they indicate a more sustained acceleration in the business that we as investors can potentially count on continuing?
The trends over the last few years clearly indicate a sustained acceleration, not just a one-off spike. Look at the progression. Their annual revenue growth has ramped up from around 13% back in 2023 to a projected 24% for the full year 2025. Gross margins has steadily expanded, moving from around 35% maybe 2 years ago to closer to 37% now. That shows pricing power and efficiency gains. And free cash flow has consistently grown, maybe from around $500 million annually a couple of years ago to a projected run rate closer to $1 billion now or in the near future. The clear implication here is that sustained, strong demand driven by the multi-year AI build-out could potentially push their growth rates consistently above 30% in the coming years, reflecting their increasing indispensability in this ecosystem. However, it's always important for investors to maintain perspective. Any significant unexpected slowdowns in AI capital expenditure across the industry could risk compressing those high margins if competition intensifies for slower growth. But for now, the momentum is undeniably strong and points towards sustained high performance.
What are the current events or news items that are shaping investor perceptions right now? And what's the general buzz, the sentiment among investors regarding Vertiv at this moment?
The recent news cycle is definitely buzzing with their exceptional second quarter 2025 earnings results. That robust 35% sales increase, the earnings per share hitting maybe 95 cents, which beat analyst estimates by a healthy 14%, and critically, the raised full-year guidance to $10 billion in revenue, these all generated significant positive attention. The fact that AI-specific orders hit another $3 billion in the quarter reinforced the narrative of continued strong demand in their core growth engine. Other developments, like strategic partnerships, for instance, their collaboration with Oklo exploring advanced nuclear power solutions for future data centers, also signal a proactive approach to long-term resilience and innovation, which investors tend to like. Looking ahead, upcoming events include an Investor Day scheduled for the fourth quarter of 2025. This will likely be a key catalyst where management will detail their longer-term AI roadmap, financial targets, and future growth initiatives. Investors are also keeping a close eye on potential external factors.
Things like potential tariff impacts resulting from upcoming U.S. elections, which should potentially hike input costs by maybe 5%, depending on the outcome, or any signs of new AI regulatory scrutiny emerging from various global policy discussions or 2025 trends reports. And naturally, their next set of quarterly earnings for the third quarter will be crucial for getting an update on that massive backlog and seeing if the order momentum continues at this torrid pace.
What's the general narrative unfolding among individual investors? Say on social media platforms or investment forums, what's the prevailing sentiment and where are the main points of debate happening right now?
On platforms where individual investors congregate, The sentiment towards Vertiv is largely bullish, overwhelmingly positive right now, especially focused on their strong positioning within the AI infrastructure theme. Sentiment indicators might lean somewhere around 70% positive following the recent earnings beats. The primary concerns, when voiced, typically center on valuation, is that 50 times trailing PE ratio sustainable, and those potential geopolitical risks, particularly around tariffs and trade tensions. However, priorities in most discussions revolve around positive indicators like the consistent backlog growth, the strong margin expansion, and the validation from partnerships like NVIDIA. For example, you see analyses shared highlighting accelerated AI deployments enabled by Vertiv's technology post-earnings, and these tend to garner significant positive engagement and reinforcement within investor communities. While there might be some lingering frustration or caution stemming from the share price dips experienced back in 2022, there's also a strong sense of awe, almost disbelief sometimes, at the powerful 80% plus rebounds that have followed. The dominant narrative firmly establishes them as a clear AI infrastructure leader. Overall, optimism definitely prevails, though you do see some undercurrent of fear among a minority about a potential broader AI hype bubble eventually bursting.
All right, now for the core of it all, the valuation puzzle, and ultimately, our answer to the big question we posed at the start. How should an individual investor listening right now approach valuing this company given everything we've discussed?
Valuing Vertiv definitely demands nuance. Its significant exposure to the high-growth AI sector amplifies its potential, absolutely, but it also introduces a degree of market volatility and requires careful analysis. Let's try to break this down to empower you with some clarity. Starting with intrinsic valuation methods trying to determine what the company is worth based on its future cash flows. Discounted cash flow, or DCF, models are common here. For example, one might project Vertiv's free cash flows starting from, say, $1 billion in 2025, and assume they grow at a robust 25% annually for the next 5 years, directly driven by AI buildouts. Then, assume growth settles into a more moderate terminal rate, maybe 3%, indefinitely after that. You'd then discount all those future cash flows back to their present value using an appropriate discount rate, often the weighted average cost of capital, or WACC. For a tech infrastructure company like Vertiv, maybe an 8% WACC is reasonable, reflecting typical risk and return expectations. Running those numbers might yield an estimated intrinsic value somewhere in the range of $120 to $150 per share. This assumes, critically, that their current strong profit margins, around 20% operating margin perhaps, persist over that period.
Okay, that gives us an intrinsic perspective. How does this stack up against its peers when we look at relative valuation? Is the market currently giving Vertiv a fair shake compared to similar companies? Or is it trading at a significant premium or discount?
Relative valuation compares Vertiv's multiples to those of its peers. Its trailing price-to-earnings PE ratio, recently around 50 times, certainly looks high compared to some industrial or even tech hardware peers, which might trade closer to 30 times earnings. However, as we discussed, Vertiv's premium is typically justified by the market due to its significantly higher growth rate projected at 24% annual revenue growth, versus maybe only 10% for some competitors. You pay more for faster growth. Looking at another multiple, its enterprise value to EBITDA ratio might be around 30 times. This also compares to a peer average, perhaps closer to 20 times. This could signal potential overvaluation if that AI-driven growth were to unexpectedly slow down significantly. But again, it's important to look forward. The forward PE ratio, based on projected earnings, drops to a more palatable 35 times. This suggests that as earnings grow into the valuation, it becomes more reasonable, assuming those growth forecasts are met.
Are there any other valuation approaches that might offer different perspectives or cross-checks on these numbers?
Yes. Another method sometimes used, especially for companies with distinct business lines, is a sum-of-the-parts valuation. This involves trying to value each of Vertiv's major segments, power management, thermal management, cooling, and IT infrastructure services separately, as if they were standalone businesses, and then adding them up. For example, one might value the power segment at, say, $4 billion, maybe applying a 15 times EBITDA multiple. Value the higher growth cooling segment, with its strong AI exposure, more richly $5 billion, perhaps a 40 times multiple. And value the stable services segment at $1 billion, maybe 20 times. Adding those parts together could also lead to an estimated total equity value, translating to around $150 per share, providing some convergence with the DCF approach. For context, as of our recording date, around August 5, 2025, the stock was trading at approximately $138.76 per share. So slightly below some of these fair value estimates, but not dramatically so.
Now, for individual investors, the concept of a margin of safety is absolutely crucial when making investment decisions. It's about protecting yourself from being wrong. How does that apply here, and what does it look like in practice for a stock like Vertiv?
Absolutely. The margin of safety principle, popularized by Benjamin Graham, is fundamental. It simply means aiming to buy a stock significantly below its estimated intrinsic value. This creates a buffer, a cushion, against potential errors in your own analysis or against unforeseen negative events impacting the company or the market. For instance, using our estimated fair value range of $100 and $150, applying a 20% margin of safety to the higher end, $150, would suggest a target purchase price around $120. Buying at that level would provide a substantial buffer to protect your investment against potential risks, like a temporary slowdown in AI spending or broader market corrections. Overpaying for a stock, buying it above or even at its fair value, significantly amplifies potential losses if things go wrong. This makes a diligent valuation process and adherence to a self-defined margin of safety essential for guiding your capital allocation decisions, especially in a hot sector like AI infrastructure, where speculative bubbles can sometimes form quickly. Personally, I find that using a hybrid approach combining insights from a DCF model with checks against relative multiples and potentially a sum of parts analysis is often best. It helps capture both the tangible financials and the more intangible aspects of AI-driven growth potential, while still grounding the decision in fundamental value.
Okay, so we have these various perspectives on valuation. What are the key arguments for and against investing in Vertiv right now? Let's give a fair hearing to both the bear case and the bull case.
Certainly. The bear thesis often starts with valuation concerns, arguing that a 50 times trailing PE ratio is simply too high, reflecting excessive AI hype. Bears might suggest Vertiv provides essential but ultimately commoditizing infrastructure, not truly proprietary, high-margin AI technology like advanced semiconductor designers. They might also emphasize risks like potential tariff impacts, eroding margins, increasing competition from both established players and nimble newcomers, and macro pressures like rising interest rates potentially increasing the cost of servicing Vertiv's debt. This perspective might conclude that the stock is vulnerable to a significant correction, perhaps even halving, if AI capital expenditure growth were to slow materially from its current breakneck pace.
Okay, that's the cautious view. Now, what about the bullish argument? What do the optimists point to that makes Vertiv a compelling investment opportunity even at current levels?
The bull thesis naturally highlights Vertiv's clear leadership position in the critical AI infrastructure market, pointing to that sustained 30% plus order growth directly tied to AI demand. They emphasize the massive, multi-year total addressable market opportunity as AI build-outs continue globally, and Vertiv's specific edge in high-efficiency liquid cooling needed for these deployments. Bulls will also stress the company's expanding profit margins, demonstrating operational leverage and pricing power. They'll highlight the substantial share repurchase programs, returning capital to shareholders, fueled by strong and growing free cash flow generation. This more optimistic outlook often projects significantly higher stock prices based on the expectation of sustained high double-digit growth for several more years as the AI revolution unfolds. They see Vertiv as a primary beneficiary, an essential enabler.
Given these compelling yet contrasting arguments, what's the most probable outlook for the company's trajectory in the coming years, in your view? Where does the balance of evidence seem to lie?
Based on the current evidence, the bull case appears more probable, or at least holds a higher likelihood over the next few years. Why? Because artificial intelligence isn't just hype. It appears to be a fundamental secular trend, a long-term technological shift that will continue to drive substantial infrastructure demand for the foreseeable future, regardless of short-term economic fluctuations. That massive $6 billion backlog provides very tangible evidence of sustained demand, giving significant revenue visibility for the coming quarters and likely years. It shows customers are locking in capacity. Now, at its current price, around $139, the stock does trade at a slight premium to some intrinsic value estimates, as we discussed. But this premium is arguably justified by its strong momentum, its clear leadership position in a critical high-growth sector, and its demonstrated execution capabilities. This suggests that perhaps buying on significant dips, taking advantage of market volatility to establish a position with a stronger margin of safety, would be a prudent strategy for you as a long-term investor considering this name.
We've discussed the business, the leadership, the finances, the risks, and the valuation. Now let's bring it all together and answer our big question definitively. Will Vertiv continue to be the go-to provider for power management, cooling solutions, and IT infrastructure in the demanding AI space for decades to come?
Yes. Based on the analysis, Vertiv is strongly poised to remain the go-to provider, the indispensable partner in this space. Its position is built on unmatched expertise and strategic foresight, grounded in that long history of pioneering cooling technology stretching all the way back to the 1960s with Liebert. It has successfully evolved into a focused, pure-play leader in critical digital infrastructure, capturing an impressive 25% global market share in thermal management right amidst AI's explosive growth phase. The evidence is compelling. That 35% revenue surge in the second quarter of 2025, fueled by $3 billion in new AI-related orders in that quarter alone. Their continuous innovation in areas like advanced liquids cooling directly addresses AI's unique challenge managing maybe 10 times greater heat density than traditional workloads. This makes them fundamentally indispensable to the AI build-out.
So you're confident this isn't just fleeting hype, not a temporary surge that might burn out as the initial AI gold rush subsides. This sounds like a conviction call on their long-term positioning.
I believe the evidence supports that conviction. This isn't just about riding a wave. The leadership team has masterfully pivoted the entire company strategy toward AI through timely, strategic acquisitions like Coolterra and E&I Engineering, through critical partnerships like the one with NVIDIA ensuring seamless integration. These moves ensure their continued relevance and deepen their competitive moat. Remember, AI data center growth is projected at a 30% compound annual growth rate for years to come. This aligns perfectly with Vertiv's core competitive advantages: high switching costs for customers, extensive proprietary technology protected by patents, and significant economies of scale. These factors make technological obsolescence seem highly unlikely in the foreseeable future. While competitors will undoubtedly challenge them at the edges, Vertiv's established oligopolistic position in the core market and its dominant 80% revenue concentration in the data center sector effectively secure its foundational role. There's a very high probability, based on current trends and their strategic positioning, of enduring dominance as reliable, efficient digital infrastructure becomes absolutely non-negotiable for global technological and economic progress.
Before we wrap up, are there any less obvious indicators or perhaps unique insights that individual investors should consider? Something beyond the standard metrics that might give us an additional edge in understanding Vertiv's potential?
Yes, a few things come to mind. First, from a fundamental perspective, step back and realize AI infrastructure isn't optional for these tech giants. It's becoming existential for their future competitiveness. Vertiv's proven ability to enhance efficiency, reducing energy use by up to 30%, in some cases, positions it not just as a supplier, but as an indispensable partner in managing critical operational costs and meeting vital sustainability goals. That efficiency focus is key. Second, while less conventional and purely analytical food for thought, some financial models explore how companies holding significant cash might consider diversifying treasury assets. Just as companies hold hard assets, some explore if digital assets could complement balance sheets in volatile times, potentially amplifying returns or hedging against currency erosion. This is purely an analytical perspective on long-term treasury strategies sometimes discussed, not an endorsement of any specific action for Vertiv. Third, and more concretely, pay close attention to that massive $6 billion backlog. It signals locked-in future growth that casual observers just looking at quarterly revenue might miss. Analyzing the backlog trends, the book-to-bill ratio, often provides clear buy or sell signals before the actual earnings results are widely reported, offering a potential information edge. And finally, don't underestimate the soft factor we touched on earlier, their demonstrated ability to attract and retain top engineering talent, particularly AI infrastructure specialists, faster than many of their peers. In a talent-scarce industry, this is a significant, often underappreciated long-term competitive advantage. People build the moat.
So what we've really explored today reveals a company deeply, inextricably intertwined with the future of artificial intelligence. It's a truly compelling story of adaptation over decades, strong strategic leadership, and vital technological innovation that literally underpins our increasingly digital world.
Exactly. Vertiv has consistently demonstrated this remarkable ability to not just react to massive market shifts like the rise of cloud or now AI, but to actively anticipate and shape them. The fundamental physics of energy demands in the AI era practically ensure their continued relevance, positioning them as an indispensable guardian of the digital world, enabling advancements across countless industries.
As you, our listeners, consider the implications of this knowledge about Vertiv and the critical infrastructure supporting AI, perhaps ask yourself this question. In a world increasingly defined by the power and reach of artificial intelligence, what other fundamental, perhaps currently unseen infrastructures will become absolutely non-negotiable for sustained technological progress in the coming decades? And how might anticipating those future needs fundamentally reshape investment strategies, not just for tech, but across the entire market landscape?
Love this? Drop a like, subscribe, and ring a bell so you never miss a podcast.